Hello traders, Gary Wagner here, just after 10:30 in Honolulu, 3:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is February 21st, 2014, and this is the daily report for gold and silver, our weekend review. And what a week we've seen. After hitting a new high early in the week, we had a couple of days of retracements, only to see the market recover today. Current print on the screen, 1324 and change. Puts it up about $1.80 on the day. The low, 1350.40. The high, 1329.20. That's according to Kitco. Highs and lows, according to eSignal, in terms of the COMEX futures, are listed here on the left. Silver also trading higher on the day. Current print 2181 puts it up according to Kitco 3 cents on the day, 2151 on the high, 2206 on the high, 2151 on the low. First, to our current trade and stop. We are long gold. We are long gold either at 1258 or 1266. It depends on whether you took our call as a conservative call or an aggressive call, but if we kind of wind the clock back, you can see this is the area that we got in at. I'm just going to kind of draw it as a band. And really what we were playing on this particular trade itself is the market had been moving higher. We had these succession of higher highs here, and they were also characterized by higher lows. Market moves up, but then we hit this kind of a band in which we had the market on the high side coming down, meaning it found some real resistance in this area. But when that market appeared as though it was going to break out to the upside, we took a stab at it. And as I said, our signal came in roughly 1258 right here and then 1266. We initially had our stops, of course, below the market. As the market moved up, we began to trail our stops up. Eventually, we trailed them to just below 1300. I believe that was at the beginning of the week on Sunday. And then throughout the week, we raised it. We raised it just the other day to put it below 1307.50. That was the actual call. Low in the market, of course, I believe was 1307.10, but our stop is sitting under here. We're keeping our stop there. So in terms of short-term or very, very interim support in the market, we're pegging it right now at 1307. You can see that by the virtue as this market came up, and this is our very, very short-term resistance at 1329 to 1330, which is where we forecast gold prices to go, I believe about a week or 2 weeks ago as the market was rising. This was our first initial target. One of my primary reasons for raising our stop up very, very tight was the fact that we had, in essence, hit our initial target price, that being 1330, call it, and the market began, as you can see, to back off. And my sense was that when we did a simple fib retracement, and the fib retracement that we did just covered part of this rally, because we were just looking at this part of the rally, and then a 23% retracement of that is how we derived this number of 1307.85. And so by putting it below 1307.50, I felt if the market was going to continue to come down, it might in fact break through 13 and simply go to a 38% retracement, as you can see here. 1294 is that retracement, and I really didn't want to give back any more than we had to. We are still long this market, and our stop is still in place. Traders, my recommendation is to absolutely keep stops as well as your long position intact over the weekend. Traders pulled out a daily chart, and I'll compress this to show you where these side numbers come from. But in essence, what interests me about this week in trading, you can see on a standard candlestick chart, we have this clear succession of upward movement in the market. Market literally barrels through a couple of different resistance levels that we had, 1277, 1307. We barrel right through those, and it doesn't really stall. This simply horizontal line is a horizontal line that I put in because that was the number that we actually were targeting. But as the market came up, we can quite clearly see that it hit our numbers pretty much exact. And then we had these two retracement days. First retracement day, it hits actually the same, a double top. So we have in terms of candlestick patterns, it can be called tweezer tops. Tweezer tops are where you have equal highs. There's another particular candlestick pattern that this really looks like, which is a dark cloud cover. Now, a dark cloud cover, of course, is simply a scenario in which you have a candle. This is spot, so it will open at, can't open above because it's continuous contract or continuous market, excuse me, but it opens at and then closes at or below the midpoint of the prior candle. And we can safely say that we closed below the midpoint. We actually got confirmation on the following day. As you know, confirmation on a daily chart is lower low, red candle, lower high. And we got that. Of course, we were long the market, and so we're not initiating a short. What we did because of that pattern also was simply really tighten our stops up and tighten them, saying, look, if it's going to make a new low here, this is where we want our stop to be. Now, of course, fortunately enough, that stop did hold. And when we have a stop hold that's this close to where the market low came, we had a little bit of skill and quite a little bit of luck in there too. But we're still long. If we look at today's candle though, although we've had a higher close, it is green, it is in essence unchanged, and we are getting this doji type candle. So now in terms of upper level resistance, in terms of support, I believe that we have eloquently pegged support currently just at around 1300, 1307. That seems to be the intraday low that we hit, and that's where our real support is. Now, real resistance right now, I'm pegging at about 1336. That is our 61% retracement. And then once we get above there, I should say if and when we get above there, it's really this top right here at around 1360. That's where I would look for some sort of resistance to come in. We have another top just on top of that. That's at 1373. And then, of course, 1435. So the real numbers that we need to look at next week, if in fact the market continues higher, is going to be this interim top here, of course. 1336 is going to be our first numbers right in there. Then we have another one at about 1373 and then 1435. So those are the different levels of resistance that we want to keep in mind. Support we've already gone through, but 1307, and then support below that is 1277. Now, traders, all I've done is I've converted our daily into our weekly. We still have the same fib levels, all the same area, but it really gives us a more clear indication of the week that we just had. Nothing like the prior 2 weeks, because, of course, as this market came up, we had this one red candle. This is that down week in which it found support, about 1240. But the week just prior to this was one of the most dynamic weeks we've seen. You can compare it to recent history. There are places where we've seen these kinds of dramatic moves, but the occurrence isn't all that common. So it's an interesting sign. Now, when we look at the week rather than the day, you can see that's almost doji-esque. And I mean doji-esque because the open and close are very, very close together. And in terms of the highs and lows, that body size is roughly 1/4 the size of the range. So we've talked about where we want to see this market go and also where we think we could run into resistance if, in fact, the market continues higher. Traders, this is a daily chart, standard candlestick format, but it's really not the candles that we're looking at on this particular chart. What we really want to study or focus in on is two things. One, we have an exponential moving average, and that's off the daily, and we've got it at a 14-day cycle. The second thing is the fact that we have our Andrews pitchfork in here. We have our handle, which is drawn off these highs right here, record highs. Then we simply fix the other 2 points, which is this low here and this low here, and these form our two outside blades, which of course is 0 and 100%. What this allows us to do is, as a market is moving down, we can see if it's breaking through these channels or if it's trading on the channel. So for example, as the market was trading down at the beginning of this sell-off, you can see that it was pretty much channel bound. But when we had this precipitous drop here, you could see it went below channels and then started trading back up. And it wasn't until it hit this 23% retracement, let's kind of put that in, or 38, excuse me, that it got a little bit of resistance. And you can see that resistance also held each time the market played up, and that's very, very similar to our long-standing resistance line that we talked about breaking, because here's that break above that. Now, we find support, 61% level, but it's just recently broken through the 23. So although we got a clear-cut signal when we look at our long-term retracement line, this gave us some information that it broke again above a pretty substantial area, and this is an area that it was unable to break through on these last two occasions. So it does give us some unique information that we really can genuinely only get from the Andrews Pitchfork. And of course, here is a daily chart. This does have our fib retracements, but it also has our Elliott wave count, and this has our intermediate count as well as our sub count behind it. And what we're doing here is we're looking at our current Elliott wave count and the current model that we're dealing with. And just a real quick review in terms of our intermediate count, wave 3, 4, 5, we go into some sort of correction in ABC. I believe that at that point we went back into an impulse phase, but that impulse phase broke. We truncated it and we ended that. That's why I've labeled this as X. We then go into a bear count, 1, 2, 3. I believe we've completed wave 4. I believe we have completed wave 5 with a double bottom and a truncated fifth wave. And I believe that now we're in a counter trend. That counter trend is going to consist of some sort of an A, a B, and then a final C. Now, if the sentiment that is prevalent in the market now is prevalent in the market, say 2 months from now, as this cycle kind of unfolds, we'll go back into some sort of a bear count, 1, 2, 3, 4, 5, if the sentiment changes. In other words, if we go back into a bull count, then we go back to our old standing 1, 2, 3, 4, 5, ABC down. Right now, we are in a counter trend. We have had no evidence to point that it's any different than a counter trend. And over the next month, I will begin to explain what criteria we would have to see gold hit for us to reevaluate whether or not that bear count is still standing or whether or not we should be using a bull count. Right now, though, my sense is we are in some sort of a counter trend. This counter trend, this last rally, A, will be followed by a B wave, which will be a lower pricing wave, and a final C wave to the upside. We've talked about where we think that could take us to, and I'm still holding to, I'm looking at about 1435, because if it goes past 1435, that's one of the criteria that would give us some clues and some indications that sentiment has changed and we could be back into a bull count. As of right now, though, we are under the model or belief system that we are witnessing a basic counter trend to a bear market in gold. So traders, in terms of a large view, I've pulled up our weekly chart. And our weekly chart, of course, this has got just our intermediate. You would put our major count above this. Long-standing resistance line. It's absolutely clear we have broken that. I do believe that we formed our double bottom here. And so what we really had was descending tops and a flat bottom is one way to describe it in terms of a Western pattern. But we've gotten this absolute breakout. And as I said, my real target we've gone through, but upside potential over the next couple of months, I believe, still is above 1400. And that's based upon this particular top, our one major rally of 2013. So traders, what about silver? Well, there's no doubt these last couple of weeks have been extremely dynamic. We're looking at a weekly chart, Japanese average format. And my sense was prior to this breakout that we just couldn't break above these tops. We did that towards the end of last week when gold broke. And this week we've had this dynamic rise. We're currently trading 2179. And in terms of some real resistance, my numbers show me that the next real level of resistance is going to be about 22.25 with an absolute level of resistance, a top level of resistance that's equivalent to $14.35 in gold. It's got to be $23 in silver. We'll take a look at silver and see how we can implement that and add that to our current market strategy and positions next week. This has been Gary Wagner wishing you, as always, good trading. Definitely got it this week. We'll talk to you on Monday for another daily update and review. Bye-bye.